And again, if you're just joining us, we're going to wait about another minute or two just for everybody to join us. It's not quite 2 o'clock yet. We've got just a couple more minutes. Thank you all for joining us and being here. Hi, everybody. My name is Scott Lacy. I'm a consultant with the ASBTDC, and you are joining the webinar for it's entitled our Fall Financial Series. And the topic that we'll be talking about today is the #1 killer of small businesses, which is cash flow. If you don't know a lot about the Small Business Development Center, it is a one-stop shop for startups and existing small businesses. We're associated with the University of Arkansas, and we're also affiliated with the statewide Arkansas Small Business and Technology Development Centers, mostly located in partnership with the major universities within the state and nationwide. There are over 1,000 small business centers across the nation. Locally, we offer complimentary one-on-one consulting and programs covering the relevant topics for business owners. And if you're not already a client, we would encourage you to visit us at sbtdc.uark.edu and click Get a Consultation in the top right-hand corner of the website, or you can just send us an email at sbtdc@uark.edu. You can also give us a phone call at the number there on the screen. Again, my name is Scott Lacy. I'm a consultant here. I've been here for about 1.5 years now. If you'd like to get in touch with me personally for a consultation, I'd love to speak with you and give you whatever help I'm able to. My email is right there on the screen for you. So I have personally owned 2 small businesses. The first one I owned was a jewelry manufacturing company, and the second one was a spa product wholesale business / coffee shop that I owned with my wife. The pandemic kind of took me out of that, but she is still operating it from our house. And I'm doing this and helping her with a little bit of that on the side. So lots of small business experience in my background. I really love it. My specialty is startup and finance. I've also spent some time in the corporate financial world and just really enjoy numbers and spreadsheets and all those fun things, which is why I'm doing this. And also really love helping people out. We've tried to use all of our businesses to have some kind of good, positive social impact as well. And so I'm really thankful for this job to be able to help people run their businesses, but stay involved in the business world at the same time. All right, so also wanted to mention today that we have got 2 options for you to be able to interact. This session is designed to last around 30 to 40 minutes with some Q&A at the end. I'm open to Q&A, up to an hour for the total webinar after, the regular main portion of the webinar. So 20 minutes or so for Q&A. So on your Zoom screen at the bottom, you'll see 2 boxes. One is this chat box and the other is the Q&A. If you could ask questions in the Q&A, that'd be great. But if you accidentally enter it in the chat box, that would be fine too. But if as I'm going through the webinar today, if you've got questions that you think of, and you just want to type it in there for me to get to after the webinar is over, that would be great. And then once the webinar is over, you're still free to answer questions as well. All right, so with that, we are going to dive in. So the #1 killer of small businesses, cash flow. So what is so important about cash in business? Well, simply stated, a really easy way to remember it is that cash represents as gas is to your car, cash is to your business. When your car runs out of gas, it stops moving. And when your business runs out of cash, it stops moving as well. Your bank account is like your gas gauge. The more money you have, the higher your gas gauge is. Thankfully, the bank account can never get full like a gas gauge can. That's about like a gas gauge can, but that's about the only difference. But it's just a good way to think about it is that gas equals cash for your business. So what's so important about cash? Well, this is a really important concept to understand, that businesses can actually have net profit losses, but still remain open. But if a business doesn't have any cash, the business can't operate. So you can be looking at a profit and loss statement or an income statement, and you can show a net profit, but if you could show a net loss. So you could actually spend more money than you're making off your sales and have a net loss and still stay open, because at the end of the day, you may have a cash surplus that you're able to operate from, or you can go out and get investment, or you can go take out a loan and still remain open. So the main thing you want to remember is that you can be operating at a net profit loss, but still have cash and be able to remain open and operate. And it's a concept that a lot of people overlook when they're opening and trying to run their businesses, because it's a little bit counterintuitive. So why is cash important? It's because you can remain open even if you have a loss, as long as you have cash. But if you run out of cash, you're going to go out of business. So why do businesses run out of cash? So two big reasons. One, a general misunderstanding of the financial data, and a failure to plan, also known as planning to fail. I'm a real big fan of that phrase, failing to plan is planning to fail. So these are the two big reasons, and these are what we're going to dive into deep today. So first of all, misunderstanding of financial data. What does that mean? Well, the financial data that's most commonly misunderstood that causes businesses to run out of cash are misunderstanding the key differences between the income statement and the cash flow statement. Also misunderstanding the difference between profit and cash. And most people tend to think of cash as their bank account balance, which it typically is. The other reason, failure to plan, which, getting into detail, is a failure to forecast or to cash forecast, and also a failure to budget. All right, so before we dive into how not to run out of cash and how to take care of budgeting and forecasting and understanding the financial statements, there's a couple of things I need you to understand about your business and the way financial statements are put together and the way cash and financial transactions are reported in your business regarding cash. So there's two methods of accounting in business. The first is cash, and the second is accrual, that you'll see on the screen here, cash versus accrual. What that means is that if you're a business, you've got two options in keeping your books and doing your accounting. You can do the cash method or the accrual method. So what's the difference? The cash method records transactions in your books or in your bookkeeping only whenever cash changes hands. The accrual method, transactions are only recorded once the sale is made, or once the revenue is earned, or once the expenses are accrued, even if cash hasn't yet changed hands. So for example, in a cash business, if you make a sale to somebody and they immediately give you the cash, then you would record the sale in your books. And the accrual method, if somebody buys something from you and you say, don't worry about it, don't worry about paying me for 30 days, even though you don't receive any cash immediately, you would still record the sale. Let me give you another example. If you're doing your bookkeeping and accounting under the cash method and you make a sale and somebody says to you, I'm not going to pay you now, I'm going to pay you later, then even though you've made the sale and you've earned the revenue under the cash method, you would not record that transaction because you have not yet received the cash. Conversely, if you were in the accrual method, you would go ahead and record that transaction because you've earned it, even though you have not received the cash. Most businesses, or most larger businesses, will be using the accrual method, and a lot of small businesses, I recommend to use the accrual method too. Not every small business, but most small businesses. And the reason that I would recommend accrual over cash is because in general, the accrual method gives a better picture of what is actually going on in your business and of the business's performance. The cash method is not necessarily as much of a reflection of what's going on in your business, so much as it is a picture of the cash coming in and going out of your business. So the cash method reflects really more cash coming in and going out, whereas accrual doesn't so much represent cash so much as it does actual business performance and actual business activity. So it's just a real quick summation of cash versus accrual. And that's really important to understand, because when you're looking at managing your cash so you don't run out of cash and so you don't go out of business, if you are keep doing your books under the cash method versus the accrual method, it's a little bit easier to track your cash so you don't run out of business than if you are doing the accrual method. Trying to keep things really, really simple there. So second thing I want to mention before we dive into how to manage your cash better is looking at sources of cash. So there's more than just one source of cash in a business. Most people, just in a quick thought, they think that the biggest or the only source of cash in a business is the cash from profits or cash from sales after expenses. And in reality, we've got really three other sources of cash as well. One is debt, so taking out loans, using credit cards, that kind of thing. The other is investment, so putting your own funds in or funds from somebody else who's investing or buying ownership in the business. And then another, we've got sort of a broad other category that doesn't really come with any liability or investment. This is also known as crowdfunding. Sometimes this could be grants. Sometimes this could be even money from family that they're not expecting you to pay back. So just basically donations from families. We've seen a lot of that this past year with the pandemic through things like the Paycheck Protection Program. Sorry, that wasn't expected to be paid back. It was forgiven. Okay, so I want you to keep these two things in mind as we move forward, that in accounting, there's two different methods for tracking your financial transactions. There's the cash method, the accrual method, and these are the different sources of cash for your business. Okay, so understanding cash in your business. The main places that we want to look at for looking at cash or analyzing cash in your business are the income statement and the cash flow statement. And I'm going to show you those two examples of those here in just a second. And we also need to understand the difference between profit and the difference between our cash or our bank balance, or the relationship between profit and our bank balance. And I want all of you to remember the most important concept that you can take away from today is that profit does not equal cash. And what I mean by that is most business owners, or many business owners, especially in the beginning, will look at their income statement or they'll look at their profit and loss statement, same thing. And they'll say, oh, I made money this month. I had a net profit. And then they will go and look at their bank account, and suddenly their bank account doesn't have all the money in there that's reflected on their profit and loss statement, and they will wonder why. Sometimes they'll even run out of cash. And the reason is because profit doesn't necessarily equal cash, because things on the income statement and the cash flow statement are a little bit different. So here's just a brief overview of an income statement, or also known as a profit and loss statement. At the top here, you have your revenue, which is all of your sales, then your cost of goods sold, which is the cost to you of the products that you sell. That gives you your gross revenue. Then the next section down is your sales expenses and your general expenses, your admin expenses with your depreciation and interest. That gives you your operating profit, and then you subtract taxes, and that gives you your net profit. So income statement, real simple, is revenue minus expenses equals net profit. Conversely, the cash flow, they're related but not the same, tracks actual cash. Not everything on the income statement is cash, but everything represented on the statement of cash flows is cash. Statement of cash flows you get is in this form. You take your net profit, and then you adjust for net cash from operating activities, and take your net cash from investing activities and your net cash from financing activities, and you get your net cash flow. Operating activities are just your general business activities. Investing activities would be purchasing or selling property, plant, and equipment. Net cash from financing activities would be if you take out or pay back a loan, usually a long-term loan. So here's where people usually get in trouble, and here's how to sort of begin understanding how not to get in trouble with your cash. So there's really big differences between the income statement and the cash flow. The income statement, I'm going to go back to this. The income statement, not everything on the income statement is a cash, is an actual cash out, doesn't actually represent a real cash outflow. There are things on here that are expenses that don't represent actual cash leaving the business. So some of those things would be, so some non-cash items on the income statement would be depreciation, interest expense. Sorry, that one's incorrect, actually. Strike that interest expense. That would be a cash that would be going out. Sorry about that. That was incorrect. Sales on credit and expenses paid on credit. So what is depreciation? Depreciation is the expended useful portion of a piece of equipment or property that is used during that period of operations. So just basically the way that accounting is done, if you buy a big piece of equipment that you're going to use for multiple years, instead of putting that entire expense in 1 month on your income statement, usually what will happen is only a portion of that expense will be allocated every single month to your business, and that portion is also known as the depreciation, or can be looked at as depreciation. So that depreciation expense will show up here on your income statement, but you've already paid for it, you've already had the cash outlay for it. So even though you've got the depreciation expense here, it doesn't actually represent a cash outflow. So even more important, however, though, is things that show up on the statement of cash flows that don't show up on the income statement. So here's some things that are cash outflows that don't appear on the income statement. So these are cash outflows. These are actual things that you give cash for that don't appear on the income statement. So that even if you show a net profit on your income statement, if you still have to pay for these large cash outlays, you may show a net cash loss at the end of the month. And the big four that get people in trouble are their inventory repurchases. So if you're a merchandising business, or if you're a business that holds a lot of inventory, like a retail business, when you go and you purchase that inventory purchase, that cash outlay does not appear, that the full value of that purchase does not appear on the income statement, unless in one case you happen to sell all of that inventory within that same period. That would be the only time. So the question is, well, where does that expense show up? That inventory expense shows up as cost of goods sold. And the way that the income statement is set up in accounting is that the only portion of the inventory expense that shows up month to month or period to period on the income statement is the portion that is represented by, that is attributed to what you sold. So if you bought 100 toys and you only sold 20 toys in a period, then this cost of goods sold would only be for the cost of the 20 toys that you sold in that period, as opposed to the entirety of the 100 toys that you purchased. And the rest of the 80 toys, that value would be represented on another financial statement that we call the balance sheet. So this is a huge one that gets a lot of people. They wind up seeing, oh, I made a profit, but they went to look at their bank account and they showed a loss, and it was because they probably had a large inventory purchase. The next one that shows up on the cash flow statement that does not show up on the income statement is the principal payment on any loans. So some people might, not everybody knows what a principal payment on a loan is. When you take out a loan on a house or a car or a piece of equipment, the bank is charging you interest for that loan. You're getting to borrow money, and because you're borrowing that money, you're using that money on what you want to use it for. And so the bank doesn't have access to that money. They can't use it what they want to use it for. And so for that trade and services, they are charging you a fee. And that fee is also known as the interest rate. And when you pay a loan back, not 100% of the money that you're paying back on that loan goes to pay off the piece of equipment that you purchased. A portion of that loan payment actually goes to the interest or the fee that the bank has charged you in order to be able to borrow that money. And there's a different split depending on the type of loan that you have. Generally, just speaking very broadly, you could assume it's like a 75-25 split. Sometimes it's more like a 50-50 split, especially in the beginning. In the beginning of a loan payoff term, you're generally paying more towards interest in the beginning than you are towards the end. So for instance, let's just say you took out a $10,000 loan and you've got to pay that back, or let's just say you took out a $12,000 loan and you've got to pay that back in 12 months, and you're paying it back in $1,000 installments. Then you only $800 of that $1,000 a month payment would actually going to pay for or contribute towards the actual equipment that you bought. And that portion is what we call the principal. And that remaining $200 that goes to the fee is referred to as interest. The $800, that is the principal, will not show up on the income statement. It won't show up as an expense because it's not truly an expense according to accounting principles. It's a loan payback or an asset purchase. And so that will only show up on the cash flow statement as opposed to the income statement. And so sometimes people will, again, look at the P&L, look at the income statement. They look like they've got a net profit, but they forgot to account for the large principal payment or large loan payment that they had to make in that principal portion, and their cash balance is less than what they anticipated it to be. The same principle works for credit cards, because really the only difference between a credit card and a loan is that a credit card is a short-term loan and a term loan is more like a long-term loan. So credit card paybacks, when you make your credit card payment every month, that payment will only show up on your cash flow statement. It won't show up on your profit and loss statement. The way that the things that you pay for with a credit card show up on the profit and loss statement is they show up as their own individual expenses when you make that purchase. And then the liability that you're incurring or the credit that you're incurring will show up on your balance sheet. And then when you pay it off, it's reflected in your cash flow statement. The last one that I see a lot of people get into trouble with is sales tax payable, especially if you're a merchandising business or a high inventory business. This sales tax payable is a liability account that grows the more that you sell, and the sales that you make, the tax you collect on the sales that you make is not reflected in your revenue. So you don't really see it anywhere at all. You don't see it at all anywhere at all on your income statement. But when you need to go and make that sales tax payable payment, it will show up in your statement of cash flows as a cash outflow. So here's just 4 real big ones that show up for most months, for most people, that can get them into trouble if they're not paying attention to it. And again, some non-cash items on the income statement. Please ignore number 2. Not sure why I put that in there, but the biggest one is depreciation, and then 3 and 4 are sales on credit or expenses on credit. Okay, so just remember, in understanding your business, profit doesn't necessarily equal cash, because there are items on the income statement and items on the cash flow statement that aren't reflected on each other. There are non-cash items that show up in your income statement, and there are cash outflows that you may have on your cash flow statement that don't necessarily appear on your income statement. So finally, how do you not run out of cash? What do you do to prevent running out of cash in your business? So two big things, really kind of 3. The first one is financial forecasting, also known as planning, and the second one is budgeting, which is also another form of planning. So here's a financial forecasting, just 4-month, very extremely concise model that I put together for you guys just to look at. Every business is different, so if you want one of these, you can actually download one online. You can just type in a cash flow forecasting template, and there's several for free. There's one on our website called Smartsheet, and I believe Microsoft has some as well that you can set up. Personally, I would really recommend you just getting in touch with me, and I would love to set one up for you. But the way that you set it up, you can go into Excel or just a pen and a piece of paper and just write down the months 1, 2, 3, 4, and then write down your starting amount of cash at the top. And then the next section down is going to be for your cash inflows. And then you're going to write down your cash, all of the cash from the sales you had in that month or from your operations, and then all the cash inflows from your investing. So from investing would be like if you sold stocks or bonds, or if you had like money market interest, income or something like that. And then cash from financing would be as if you took out a loan or something, and you got an infusion of money from a loan or from debt, or from an investment. So you're going to write down all of your cash inflows from sales or operations, investing and financing. Then you're going to get your net cash flow. So here you see it's $40,000. Then you're going to do your cash outflows. You're going to do your cash flows from operations. So this would be all of your operating expenses, like your rent, utilities, all those things. Cash outflows for investment. So this would be like if you invested in property, plant, or equipment. And then for financing would be if you had any loan payments. or paying back any financing, or if you're paying dividends. And that's going to give you your net cash outflow. And then you net those together. So 40,000 minus 30,000 out would be a net of 10,000. And then you add this 10,000 net to your beginning cash flow, and that gives you 60,000 at the end of your first month projected. And then you would just carry this 60,000 up here to the top to month 2 to start off. So the other part you want to be able to do is you want to be able to forecast your sales and your operations really well. There is a bit of an art and a science to that. It is fairly complex. No, not too complex. You can do it, but there's usually some data points that you can use to make that more accurate. It's something that we do here almost every day, and I'd love to talk with you about that as well, to help you forecast what your sales might be. The first thing to do in that is to figure out what your revenue streams are. And then you just repeat that process month after month here. And I'm happy to talk with you guys about that. The second thing you do is you want to budget. Here's just a quick example of a budget. I'm sure most of you have probably made a budget, at least with pen and paper at some point in your life. So very simply, you just want to do month 1, your actual compared to actual, month 2 compared to actual, month 3 compared to actual. You do your operating expenses first, and then do any of your big investments. And the process for that is first you want to analyze the past data that you have, or you want to analyze all of your financial statement data that you have. Then, according to your previous data that you have, you want to make decisions based on that data and allocate the capital according to the categories that you set up, the categories you set up in your budget. Then you want to monitor the spending, which is that budget versus actual. So this would be budget, this would be actual. And then finally, what you want to do is you want to enforce accountability. So if you have managers that are making these budgets and you approve these budgets, you want to also make sure that at the end of every month, after the actual numbers come in, if they're over, you want to make sure that they're justifying why they went over or informing you why they went over. And if they're going over with, in amounts that aren't approved or amounts that they can't explain, there does need to be a little bit of an enforced, possibly a significant amount of enforcement for that, because budgets are there for a reason, to help you invest in the areas of your company that you're going to get the most bang for your buck for, and also so you don't overspend and get into trouble with debt. So there's that process for budgeting. So analyzing past data, analyze the past data, allocate the capital, monitor the spending, so have budget versus actual, and have some accountability built in there as well. Additionally, if you do all of your forecasting and you do all of your planning, and you think that you're possibly going to run out of money, then you need to start planning for other ways to get some money into your business so you can bridge those gaps in your sales. Some businesses are seasonal. Christmas is coming up, so it's a great example. Some businesses do almost all of their sales in the last quarter of the year, especially retail businesses. Then they have another 9 months of the year where they've still got to pay for operations, but they might be a little bit cash short because they don't do a lot of sales the rest of the 9 months of the year. And so there's some other sources of cash out there for you to help your business to be able to bridge that dip in sales. And that first one would be debt. That's obviously going to come in the form of credit cards, lines of credit, or just term loans from banks or from community lenders. Another would be investment from an outside party or more money from yourself. The other one would be profits. Again, that would be when you actually are having sales and you've got profits to reinvest in your business. And the last is that other category. That would be things like crowdfunding on Kickstarter or Indiegogo, or if you were talking to friends and family and they had some money to be able to provide you, or potentially grants or other forms of government funding. All right, so that's all I've got. And now I'm going to get into some questions. Let me look through here and see what we've got. I'm going to make sure we know who all is attending as well. All right, so let's see if I can get to the first question. Can you talk a little bit about the investment method too? Sure. So investment simply means when somebody else gives you gives your business their personal money. And in return for giving your business that money, you're going to give them a portion of your business. So for instance, if your business is worth $100,000 and they give you $10,000, then in return for that $10,000, you're going to give them 10% of your company. So they're going to own 10% of the company. And the way that they make money off that investment is fundamentally two ways. So one is to pay, there's potentially three ways, really two ways. One is to pay a dividend. So what a dividend is it's a payment to the investors in proportion with the amount that they have invested out of the profits of the company. So if your company has a net profit of $100, then at the end of the month, if you're scheduled to give them a dividend of that 10% of they invested, then you would give them 10% of your $100 profit. So if you profited $100 and they own 10% of your company, you would pay them a 10% dividend. That is one way that investors can get their money back. You can also make an agreement with an investor where you're not going to pay a dividend. And in that case, the way that they're going to get their money back is when the business grows to a greater value and it sells, then they would get that proportion of the business back. So if the business started at $100,000 and they bought 10% for $10,000, then if you sell the business for $200,000, then their portion of that $200,000 is 10% or $20,000. So they will have made a capital gain of $10,000. If you would like to talk more about getting investors or having investment and what that means, I'd love to talk to you about that. Next question, can you explain how my bank account is much larger than my cash flow statement shows? I get confused looking at this. Absolutely. So there are three sources of cash. So when you put cash into your bank account, there's three different places that can come from. One is just from operations or your net profits. The other is debt or from investment. So if you've received any money or any cash from debt, if you've taken on any loans, that's cash that can be in your bank account that's not reflected on your income statement. The same thing for investment. Off the top of my head, if that's not the reason, then that would be the main reason. The other reason is that the cash flow statement also doesn't necessarily, let me think how to make this clear. Yeah, so that would actually be the biggest reason is if you've got other sources of cash coming in sorry, I'm trying to think through this on the fly. Your bank account is so much larger than your cash flow statement shows. That is possible. It's not abnormal. I want to dig into that more with you in person. I'm not sure if that's because you've got multiple bank accounts or if there's something going on with your investment or your financing sections. But in general, you should be matching your cash flow statement to your bank account or your multiple bank accounts pretty closely. So I'd say let's get in touch and talk through that. It's not going to be a super simple answer. Next question is, what about money we put into our business? How does that need to be noted in your records? So money you put into your business is investment or equity. And the journal entry for that would be to debit the cash account and to credit the owner's equity account. And in the owner's equity account, you want to make sure to make a specific account for you and for your name. And so that's going to increase your equity. So if you're not doing a journal entry, then just write it. You can just write it down however you want, but the journal entry for that, how it's going to be reflected on your financial statements is when you put money in the business, your cash account is going to go up and your equity is going to go up as well. So when we're looking at a business and how it's funded, we look at that on the balance sheet, and the balance sheet is represented by the formula or the equation assets equals liabilities plus owner's equity. So you've got assets on one side, liabilities and owner's equity on the other. So all of the assets come from two places. They either come from debt or liabilities, or they come from owner's equity or owner's investment. So think about cash going from you to here. So your account goes up and the cash goes up as well. So that's kind of how it's noted, just in simple non-CPA terms. All right. So I don't see any more questions, but I'm going to hang out for just a bit longer, and I'm going to keep thinking about this cash flow statement question about how it's not reflecting the bank account, and see what that might be. There's a question I've not had. But if anybody else has any questions, I'm going to wait around for about 4 or 5 more minutes before I stop the recording. Yeah, no, the more I think about it, the more I realize, not realize, but the more I'm no longer second guessing myself, that your cash flow statement, your net cash at the end of the month. Oh, sorry, that might actually be what it is. So the cash flow statement doesn't, so month to month, it's not cumulative. So you might have all it shows is the net cash increase or decrease from a single period. It's not going to add your existing bank balance to your net cash increase or decrease. It's only going to show the increase or decrease from a single period. So let me show you. So this is a cash flow forecast. This is different than a statement of cash flows. The statement of cash flows isn't going to show your starting cash. It's not going to show this line. And it's also not going to have this bottom line down here that shows your cash balance. All it's going to have is this middle section right here. So as you'll see, then I've got the net cash flow out here in month 3 as $1,200. So my statement of cash flow would show me for that period that I had a net cash increase of $1,200, but my actual bank account balance is $56,400. So they don't match, and that's why. Okay, hopefully that's helpful. Sometimes it's hard to think about these things on the fly. But definitely get in touch with me and we can talk more about it. Okay, I'm gonna hang out for just a couple more minutes. Thank you guys for attending. Really appreciate y'all. Appreciate having you here. And you can see in the chat box that the next event, when do we have it scheduled? Yeah, you can go and find the next scheduled event at our website at sbtdc.uark.edu, and then go to the events and programs tab. All right, another question. For startups in general, how long do they go without significant sales before cash flow becomes a problem? A year, maybe? You're not going to like the answer, but it genuinely depends on each individual business, not even on similar businesses in similar industries, but it just depends on each individual business. There really is no standard. So how else can I be helpful to you? For startups in general, how long do they go without significant sales before cash flow becomes a problem? A year, maybe? So this kind of gets into how much you need for an emergency reserve fund. And again, it depends on your business. If you only have sales at Christmas, but you want to operate the rest of the year, you need to have you don't have enough sales to cover the rest of the year, you're going to want a larger reserve fund. I tend to tell businesses 6 months. The smaller they are, the more, attainable that is. But the larger the business gets, 6 months tends to be a lot. But somewhere between 3 and 6 months is just a good general rule of thumb. But again, it depends on the business that you're in, it depends on the industry that you're in, it depends on how you're structured. But it's something that you really want to talk through from a risk perspective. And I'd be happy to talk with you about that if you want to shoot me an email. Yeah, contact info. Let me get that for you real quick. So there is our phone number and website. Sorry, that was a little fast. ASBTDC.uark.edu. And you can get in touch with us through that website, real simple. And if you've got your phone with you, you can actually just open up your camera on your phone, and you can just put your phone over this your phone's camera over this QR code, and it'll take you to our website. And then my personal email, my business here at the office, my business email is sl072@uark.edu. You can just shoot me an email and I'll send you one back. And I've got an app where you can click on a link in my email and it'll take you to my calendar, and you can just book a session with me whenever you're free, so long as I'm free on that calendar. We don't have to shoot emails back and forth 100 times anymore. So there's my info. And over in the chat box, if you want to register for the next webinar, we've got the link for the next webinar down at the bottom of the chat box on October 28th. Okay, just waiting on any more questions to come in. Does anybody want to see a slide again? Have anything explained again? Happy to go over there. We've got plenty of time. Financial forecast slide, sure. There we go. So this is very simple. It's very condensed. You'll want to make it a little bit more detailed than this, but this is the basic. This is just an outline, is really all this is. It's a basic outline of a statement of a cash flow forecasting model. And something I didn't mention is that I would do this every single month. You'll want to forecast, and then you want to go back and look at actual, and then you want to forecast, and you want to go back and look at actual. And you may want to forecast out as long as a year, maybe just a quarter or 6 months, but at least, a month in advance. And so up here, we just have, this is how much you have in your bank account just at the very beginning of the month. And then you've got all of your sources of cash coming into the business, and then all of your sources of cash leaving the business. And those together, they net your cash flow and gives you your ending of the month cash balance. And then your end of the month cash balance carries up to the beginning of the next month, and you do it all over again. Feel free to take a picture of that with your phone. This is also going to be posted online here in the next couple of days on our website. So you can just go to our website and check this webinar out there and look at it. If you also want to get in touch with me, I can help you build one of these for your business, and you can also download free templates online. Yeah, my pleasure. Thank you guys for being here. Really enjoy this stuff. How do you recommend we split our accounts? I have 3: operations, marketing, emergency. Any other suggestions? So an emergency account would be a savings type account. So there's not actually going to be any real outflow because that's going to stay in like in your bank account, in your emergency bank account. So there won't be an outflow for that. So you won't need to put that on your forecast. Marketing is going to be an operations expense. So marketing is actually going to be underneath operations. So operational expenses are things like rent, utilities, like personnel, or payroll. Even for inventory purchases would be under your operations. Credit card payments would be under operations. This is all talking about the statement of cash flows or your sorry, this is not your statement of cash flows, your cash flow forecasting, which is a different document. It's a different tool. So there's the statement of cash flows, and then there's the cash flow forecasting document that you can come up with on your own or that I can help you with. And on the cash flow forecasting document, you would put credit card payments underneath operations. You put inventory purchases under operations. Principal payments on loans would go under financing. Sales tax payable would also go under operations. Yeah, you're welcome. Absolutely. Really happy to do it. Would love to see some of you guys on a Zoom call or in person. Good day to do a Zoom call. Kind of gloomy outside. All right, I'm just going to do one more run through of the slides for you guys. So misunderstanding of financial data and a failure plan. So now we understand the difference between the income statement and the difference between the statement of cash flows, and you know how to plan using the cash flow forecasting document or finding one yourself and the budgeting process. And if you need money, there's some other sources of cash out there. So there's profits, debt, investment, and other like crowdfunding. Depreciation, interest, sales on credit. I remembered why I put that interest expense on there. Interest expense is on there because that that interest expense will show up on your P&L, but it won't show up. It will show up on your P&L, but the principal only shows. So there's always two parts to a loan payment. There's the principal and the interest. The principal will only show up on the cash flow. The interest will only show up on the P&L. That's why I put that in there, but I put it in there with the wrong heading. Sorry about that. So do your financial forecasting, do your budgeting. All right. Thank you guys. It was a pleasure having you. And please get in touch if you got any questions. We'd love to work with you on a one-on-one basis. We'd love to see you guys at the next webinar on October 28th, or you can register for our half-day financial boot camp that's in person, lasts from 9 to 1. We've got one coming up in Rogers and another one coming up down at the University of Arkansas Research Center down in South Fayetteville. We'd love to see you guys there. Thank you all so much.